5 a.m. in New York City. Good morning. I'm Danny Berger with your Bloomberg Brief. Here's what you need to know on this Thursday. On to the final vote. House Republicans clear a major hurdle to advance President Trump's tax bill. Trade talks, bargaining chips. The U.S. lifts export curbs on China for semiconductor design software. And it's Jobs Day. Coming a day early, forecasters anticipate the Trump admin's policies to begin hitting the labor market. The most Friday of Thursdays. If you are in the U.S., congratulations. You made it to the end of the week, and you made it to the end of the week with another all-time high on this equity market. But we are hanging tight. Little change this morning, actually exactly unchanged on the S&P 500. NASDAQ barely moves. Russell 2000 futures, those continue to outperform. It is Jobs Day, 2.5 hours. 106,000 is the estimate for today. It is a bond market that is, though, rallying this morning, led by the front end, down by 2 basis points, nearly 2 basis points for the 10-year, but it really has been the UK bond market that's been dragging around global bonds over the past 24 hours with the fiscal concerns, the scares of is Chancellor Rachel Reeves out or not. Keir Starmer confirms she is. So we're getting a big rally. You can see it at the bottom of your screen with gilts this morning. So that's lifting global bond markets as well this morning. Okay, let's get you some stocks to watch. With that, it's Joe Easton. Hey, Joe.
Hey, Danny. So we're watching these industrial software stocks this morning. As you mentioned there, we have seen news of the US removing these restrictions on China in terms of the sales of the software used to design semiconductors. All very complicated stuff, but we are seeing moves higher in Synopsys today. That's up 6%. Cadence Design Systems up the same amount as well. We saw Siemens rallying here in Europe, so keep an eye on those today. Then we've got delivery stocks in focus. BNP Paribas, Exane upgrading a couple of those. So FedEx is the one they like as they navigate the disappointing results from last week in terms of the Amazon impact. Amazon not as profitable for FedEx despite all those parcels that are delivered, and UPS also comes up as well. So gains in both of those delivery stocks this morning. Then finally, Tesla. Not so much about the spat between Musk and Trump. This is about the sales. We did see a jump in the stock yesterday. It was up 5%, getting back closer to that record high. And we're up once again this morning. So expect to see Tesla continuing that run. And as always, check out the Before the Bell opening wrap for the fantastic summary of all these news movers and more, Danny.
Joe, thank you so much. Appreciate it. And should just flag that equity markets will be closing at 1 p.m. in a holiday shortened trade. So get your movers in now. And in just moments, we're going to take a closer look at gilts in this global bond market on fiscal concerns. Noon's Ella Hoxha will be joining us. And later in the hour, we push ahead to the jobs report with Mizuho's Steve Ricchiuto. Now, UK 10-year yields are paring losses and rallying this morning after sinking yesterday on speculation surrounding Chancellor Rachel Reeves' future. Let's indeed get Ella Hoxha's thoughts on this. She joins us now. I want to get your thoughts on what's happened in the UK gilt market over the past 24 hours. Investor fears may be calm this morning after Keir Starmer saying that the Chancellor Rachel Reeves will be sticking on, who is more concerned about the fiscal picture. Just how sensitive does this market remain to be?
Yes, it's interesting because gilts are very closely watched by investors because this is where we first started fiscal concerns a few years ago now, right? So we had that mini episode of September 2022, which turned out into a major episode for bond markets. So yesterday, a little bit of a reminder of what happens when bond investors get nervous on fiscal. So you had bond yields up, sterling down, and UK equities underperforming relative to other markets. So I think, look, the mentality has shifted in bonds. We've talked about this a few other times on this show in terms of the jitters around fiscal concerns. Those remain. We're very much in that path for bond investors, and it explains why we've been seeing steepening of curves. So it's not just pertinent to gilts, but because of the need of funding from foreigners for the gilt markets, those nerves are pretty frail. And so it shows how little room there is to maneuver from a fiscal perspective, particularly for the UK.
But it also is a reminder, Ella, that though the concerns might be similar, it is a very different market between the US and UK, that you can have this instantaneous, really sudden reaction. Whereas in Washington, D.C., there is a vote ongoing right now. I believe in about 30 minutes, we're expecting the House to do the final vote for the One Big Beautiful Bill. And it's a bond market that hasn't been reacting. Is there enough premium priced in for growing deficits?
The answer is no. And the way we can compare that is if we look in the sort of pre-2000s world where we demanded more term premium to be out in the curve, we sort of repriced relative to that history, but only about halfway through if we look at our models, which means there's still more room to go. So even if just comparing to where we were pre-2000s, right? So if you look at the long history of bond markets, when there's concerns on fiscal, when there's concerns on inflation, term premium can rise substantially. So the short answer would be probably we haven't priced enough risk premium.
We haven't priced enough risk premium, but it's a market that maybe is paying more attention to the cyclical factors of where growth is going and what sort of Fed cuts we might get, Ella. Does that at the end of the day not weigh out what is, again, not cyclical, which is secular, which is what's happening with the fiscal budget? Is at least in the term, in the here and the now, are Fed cuts in the economy not outweighing that for this bond market?
I think that's the reason why the front end is more anchored. So you look at the 2 to 5 year part of the curve and yields are much better behaved. It's also one of the reasons why the 10-year yield is at 4.25%, given those fiscal concerns. If it wasn't for the cyclical weakness that we're seeing, so we're seeing things soften down in the US, then perhaps bond yields would be significantly higher. Look, I'm definitely in the camp that believes fiscal will matter for the medium to long run. It's very difficult to know exactly when we engage with that, and the case in point has been the UK, but it's very much on the forefront of investors' minds, and it's a sentiment issue. So the moment that markets decide to engage with it, you can move pretty rapidly.
Can we talk about the sentiment right now, Ella? Because risk assets have been doing extremely well, from credit to equity. How do you interpret the trend we've seen at the past 3 months? Is it renewed risk appetite and sustainable momentum, or is it just something of a correction of what was really negative sentiment to start the year?
Well, there was a lot of negative sentiment. We had a lot of event risks. We had a lot of policy reaction functions. So we've sort of priced a majority of those out. And look, volatility is suppressed, where bond yields are trading in the soft landing narrative. So if you look at that perspective, there is nothing that's sort of concerning investors too much. And we've navigated a couple of potential hotspots this year, whether that was in the Middle East or around April, with the tariffs oncoming. So we've kind of gotten comfortable to this environment now where volatility is low, growth is okay, even if it's slowing down, but it's not a disaster, and policy is easing. Because if you look at across the world, central banks have been easing policy. So this is how you can explain it. Does it mean you can extrapolate this in the future? It's going to depend a lot on what happens to inflation, because we have this base effects component that starts to peter out into the second half of the year, and how we're going to feel about fiscal, right? Because this is going to matter. And I really believe in the next 2 years, this is a very major theme for financial markets.
But if you want to buy risk assets, Ella, why would you even stop? Because we've learned, to your point, that war doesn't disrupt the trend, or if it does, it happens very quickly. You can even go back to COVID. You can go back to tariffs to start this year. The rebounds seem to be getting quicker and quicker. Ella, is it now just this Pavlovian urge to buy the dip that continues to be fortified and justified, but what we continue to see year after year?
Yes, it's been validated, right, and rewarded to do so. So you've been incentivized to buy the dip, and even the retail component of markets has learned that reaction function and has been rewarded handsomely for it. But this is where I bring this dynamic of what happens to bond markets, because I do think it could be a driver for risk over the next few years. And the reason for that is every time we've sort of gone through this range of 5% and above, we've sort of started to reprice risk in a very different way. So because we're trading in this sweet spot, there's no reason to panic. And when you get the panics, as you say, they tend to be short-lived and they're faded fast. And the policy reaction function has supported that, right? So we've had either a response from the Fed or central banks, or we've had a fiscal response, or in the case of tariffs, we had a bit of a reversal in the policy. So you've been rewarded to play that way. That's why I think, aside from that, the dynamic that could dominate is where interest rates land on the long term. And I think that's a bond market issue, and that's going to be the driver going forward.
Hey, Ella, just quickly, to be clear, do you think that 5% is higher, and higher is something realistic for something like the 10-year? Because you say that that's the level that would upset equity markets.
It's given us a good range to play for and against, right? So that 3.5% to 5% has been a strong range for us. So we've tried to push against it in either direction. I reckon over the next, I cannot tell you exact timing. Timing is not my forte, But I can say that with conviction, actually, that over the next, let's say 6 to 12 months, we're probably going to push on the upside of that and explore new highs in yield. Yes, and I think it's driven by this sort of lots of supply. Who's going to buy that supply in the absence of a major cyclical slowdown? I think that's the big question to answer.
All right, Ella, we're going to have to leave it there. Thank you so much for joining us this morning. Ella Hoxha of Newton Investment Management. Let's now get you some other top stories trending on the terminal this morning. As we've been talking about, UK markets are rebounding, paring steep losses after Prime Minister Keir Starmer said Chancellor Rachel Reeves will stay on in his cabinet for many years to come. UK markets slumped on Wednesday over speculation on Reeves' position. European companies, including ASML and Airbus, have called on the EU to suspend the implementation of its landmark AI regulation. Firms say the EU is risking its own ambitions in the field by reining in the most powerful AI models, calling on the president of the European Commission to take a more innovation-friendly approach to regulation. And a member of Bank of Japan's board has warned that the central bank's rate hike cycle will resume after what he believes is only a temporary pause. The member kept his hawkish tone despite the cloudy economic outlook, particularly amid ongoing trade uncertainty between Tokyo and Washington. Coming up, almost at the finish line, you're looking at live pictures of the House with Republicans clearing a critical procedural hurdle to advance the big, beautiful bill. The debate goes on. We'll have the latest on your brief.
Because when it comes to everyday Americans, this one big, ugly bill will hurt the quality of life of hardworking American taxpayers. And it's all designed to put a happy smile on the face of billionaires. That is inconsistent with the Declaration.
It's been a good day. We're in a good place right now. This is the legislative process. This is exactly how I think the framers intended for it to work. We feel very good about where we are, and we're moving forward. So we're going to deliver the big, beautiful bill, the President's America First agenda, and we're going to do right by the American people. This is going to be a great thing for the country. Look forward to moving it forward.
Just a few hours ago, the House finally voted to move towards a final vote on President Trump's so-called big, beautiful bill. You're looking at live pictures of Hakeem Jeffries, representative there, debating this bill. He's been speaking against it, as you likely would assume, from the Democratic representative. Let's get more now from Bloomberg's Josh Galou, who's also been tracking the vote. So, Josh, what comes next?
Well, as you said, overnight in Washington, they were able to do, the Republicans were able to clear a procedural hurdle that brought the bill to the full floor for debate and ultimately a vote, which we expect to happen relatively soon now. It's of course a major development because it answers the question of whether, many of these holdouts within the Republican Party were willing to set aside some of their skepticism about the fiscal impact of this bill, which is estimated to be roughly adding $3.5 trillion to the deficit over the next 10 years, and instead go along with the strong political push by President Trump to get this bill passed not only in its entirety, but also by the July 4th self-imposed deadline that he wanted, and it looks like it's on track to do so.
Yeah, and it took a while, Josh. It's been the longest GOP House vote in history. They set a new record with this. And to your point, President Trump putting on Truth Social, basically saying MAGA's not happy. It's costing you votes. What are you trying to prove? What are you waiting for? Josh, does this really just show that the president still has the ability to move his party in the direction that he wants?
I don't know that there's any other way to read this other than a massive victory for Trump and really just bowling over the fiscal conservatives who have stood on the sidelines here and tried to put up some barriers. They've tried to give them a little bit of political cover with an accounting gimmick where they essentially say that they don't count the Trump tax cuts from 2017 as any. They count that as the baseline. So they're saying the additional tax cuts will not add to the deficit. So that's giving them some political cover. But really here, this is a huge victory for Trump in pushing through his domestic agenda. And it doesn't really indicate that there's much opposition within the party that at least would make a difference. Of course, as we know, this is being done through reconciliation, which requires only a simple majority. It means all the Republicans, other than they can only stand to lose 3 in the final vote to get it passed. But you know, that's a huge amount of solidarity for an otherwise controversial bill that's going to really raise questions about people's reelectability depending on how this impacts their districts. They've had to swallow what are going to be massive cuts to Medicaid. You know, in rural areas, that's really going to hurt some of these people, and they're going to have to answer for it. Although some of these things are not going to take effect until after the midterm elections by design, so they may be able to dodge that bullet. But in any case, to your point, this definitely shows that Donald Trump still has his party well within grasp.
All right, Josh, we're going to have you back because, as we've been noted, this is a vote that is still ongoing. We did hear from Johnson saying that it would likely be passed before people had their morning coffee, so that could be anytime, or for our viewers, you're probably drinking it right now. Josh, thank you so much. Now, in the meantime, in Washington, D.C., President Trump announced late yesterday that the U.S. has reached a trade deal with Vietnam. It will be a 20% import tariff. Bloomberg's Brendan Murray joins us now. Brendan, do we have the blueprint? Does it seem like more deals like this are on their way?
Yeah, it seems like the trickle of deals that we've seen over the past couple of weeks. We had one with the UK, we had an extension of an arrangement with China, and then now this Vietnam deal. This trickle of deals is going to start picking up some pace over the next several days for this other deadline that Trump has set of July 9th for negotiations to conclude, for countries to put their best deals on the table, and for him to be able to announce more arrangements like this. The Vietnam deal is important because Vietnam is a place where a lot of exports have come instead of coming from China over the past few years. So Vietnam's trade surplus with the U.S. has widened considerably. So the Trump administration has this kind of two-tiered system: 20% tariffs on Vietnamese imports, and then a 40% tariff on imports deemed to be actually produced in China but just transshipped through Vietnam. So we will look closely to see whether this is a template for other deals for countries in Southeast Asia, as the administration tries to bake in some of this idea that countries ought to de-link themselves with China in global supply chains.
The market reaction was also fascinating because it was one of relief, it was one of a rally, Brendan. But if you just look at a company like On, for example, that makes the running shoe, they had assumed for their guidance a 10% tariff from Vietnam, to which it has huge exposure. 20% is double what many, including companies like this, had been expecting. Brendan, what will be the ramifications of that?
Yeah, exactly. These companies are going to they're going to take a hit on their margins in the short term, but overall it seems like the market is saying these adjustments can be made without huge damage. Remember, Vietnam was facing a tariff of 46%, which would essentially cut off a lot of, if not all of trade. So I think there's a bit of relief that the worst case scenario didn't happen, and we'll see whether other countries in the days ahead. We hear that India, and have reported that India is close. There are other countries that consider themselves to be in the final throes. Switzerland, Taiwan, the list goes on. But so we will see. That Trump has his big beautiful bill to look at today, but these trade deals are coming right on the heels of them.
All right, Brendan, thank you very much for that. That is Brendan Murray, and you're watching Bloomberg Brief. Get you some front page news this morning. First up, most outlets leading with the House bill vote. The Washington Post among them, clearing a procedural hurdle on Trump's agenda that now paves the way for passage. We're keeping an eye on the progress of those votes. Hakeem Jeffries speaking now out against the bill. Speaker Mike Johnson says that the Republican leaderships have enough votes to send the bill to the president's desk before July 4th. And an interesting one on the Journal reporting that CEOs are saying the quiet part out loud, AI will wipe out jobs. From Ford to JP Morgan, bosses are telling investors that they expect corporate workforces to be smaller while AI replaces white-collar work functions. Now, speaking of which, we are going to be getting the jobs report in just about 8:30 a.m. We're going to count down to it. We're going to be catching up with Mizuho's Steve Ricchiuto on that next. You're watching Bloomberg. It's 5:30 a.m. in New York City. Good morning. I'm Danny Berger with your Bloomberg Brief. Here's what you need to know on this Thursday. On to the final vote. House Republicans clear a major hurdle to advance President Trump's tax bill. Trade talk bargaining chips. The U.S. lifts export curbs on China for semiconductor design software. And Jobs Day coming a day early. Forecasters anticipate the Trump administration's policies to begin hitting the labor market. It is Thursday, but it is the last day of your trading week after an all-time high yet again for the S&P. It is little change this morning. It seemed that the trade deal with Vietnam was the latest fuel for the fire. But it is Jobs Day. It is a bond market, though, that is rallying ahead of that. Perhaps it's the UK bond market that's pushing things here. You can see gilt yields on the bottom of your screen after the Prime Minister reaffirmed that as Chancellor will be staying on. Your 2-year yield down by 1.8 basis points. Your 10-year yield about 1.5 at 4.26. Let's get you some stocks on the move this morning before the early close. 1 p.m. is when equities will close. Joe, what you looking at?
Hey, Danny, I feel like that early close makes my segment even more important today because you need to get those orders in before 1 p.m. But what we're looking at is the industrial software makers, given that news on the restrictions against China being lifted in terms of being able to sell the software that designs the chips to the Chinese. And we are seeing a gain in both Synopsys and Cadence Design here in the pre-market. And we also saw Siemens gaining in Germany as well. Keep an eye on those two here in the pre-market. And then in the delivery space, FedEx and UPS, both of those upgraded at Exane BNP Paribas this morning, which thinks FedEx is actually going to be the one that's going to navigate the headwinds coming in from Amazon. Amazon, in FedEx's report last week, was actually a bit of a wait, not as profitable on the stock as expected. Both of those edging slightly higher today. Then finally, Tesla getting another boost. It was up 5% yesterday following those stronger than expected quarterly sales in the EVs. We're up another 1% today. Will we soon head back to the record high? We'll have to see. But Tesla edging higher once again in the pre-market today, Danny.
Joe, your segment is always important, regardless of when markets close. Thank you very much for your work this week, Joe Easton there. Now, in just under 3 hours' time, we will be getting the June payrolls report. Pleased to say that Bloomberg's Michael McKee joins us now for a preview. Mike, great to see you. So what are you looking out for?
I'm looking out for Highway 22 in the Hamptons and how crowded it gets, how early. If we get a big number or really no number today, people are going to have to stay around and trade longer. Otherwise, we're out the door. The numbers are expected to show some impact of trade and chaos in the fiscal space, with just 106,000 as the forecast consensus, 95,000 for the whisper numbers, so Wall Street leaning towards pessimism. Unemployment, 4.3%. This is going to be a case of rounding when we look out to 3 digits, because we barely rounded down to 4.2 last month, and it could go as high as 4.4, depending on where we end up. Jobless claims are out today as well. 241,000, that's about where we are right now. So if there's a big change there, that could also have something of an influence, although payrolls is the number to rule them all. Continuing claims is the one people have been focused on, because how hard is it to get a new job? It seems to be getting a little bit harder if that number goes up to something else for people to watch. It's so early in the morning, I couldn't come up with a better title than Datapalooza for these things. We also get the trade balance today, the advanced trade number, much bigger than anticipated. We'll see when they put services into this, whether it really moves or not. ISM Services is out at 10 o'clock. Less influence now because we'll already have the payroll numbers, but people will be watching the prices paid number. That is forecast to be about where the ISM manufacturing prices paid number are, showing some inflation out there. We get factory orders, the capital goods number expected to be unchanged from the earlier durable goods report. I do have one other chart, though, Danny, I want to show you, because given the way this is all set up, yesterday we had the ADP number minus 33,000, and that's influenced everybody to move their overall forecasts a little bit lower. Last time we were this low on ADP, negative 53,000 for March of 2023. The whisper number that day was 215,000, and look what we got, 238,000. But look what happened since. They've revised that 238 down to 85. So we could get a huge number today, we could get a low number today, and it won't be accurate either way.
Great.
Steve Ricchiuto is going to join you, and he can explain why. But there is a very wide error band around this. And the bottom line is the Fed has to respond to the number it has, not the number that it eventually will be. So if we get a big or bad number today, then the markets will create an agenda for the Fed July meeting. I don't think the Fed is going to move a whole lot.
Well, good. You could have gone to the Hamptons before the ADP report. It doesn't
even
even
out
matter.
there before the traffic gets
By the way,
really bad.
Datapalooza, just the worst party.
Yeah.
Just like, come on. We need something better than
We need something better. All right. By next month, y'all come out with something.
Yeah, perfect. Mike, thank you so much. Michael McKee, looking forward to you breaking down those numbers in just under 3 hours' time. As Mike hinted at, also around the desk is Steve Ricchiuto, Chief U.S. Economist at Mizuho Securities. I'm guessing we can discount ADP on your end, too. But what are you looking for? Because, look, ADP, maybe you can't because the trend has been lower. Maybe it highlights a trend that we're going to see with NFPs, too.
Well, there's no doubt that employment growth has slowed. Uncertainty has created some economic impact. There's no doubt about that. But when you look at things like claims, you look at where claims are relative to where the trend of claims is and how low it actually is. You look at continuing claims, especially relative to the number of covered employed, we're at all-time bottoms. Then you look at the JOLTS data that came out the other day, with openings being up more than expected, with quits being up more than expected, and layoffs being down more than expected. There was the trifecta of the JOLTS data all going in the direction of, labor market's really not going anywhere. Mike's right that, data gets revised substantially. The market does react to the data as it comes out. So does the Federal Reserve. That's what they unfortunately have to do because that's where the models are based off of. I think the reality is the economy's doing okay. Uncertainty has certainly biased things down. The question is, where do we go when the uncertainty lifts? And I think the progress being made on the tax bill is being ignored. This is a fairly significant stimulus. And even though we look at it and say, when you break it out over 10 years, it's this much a year. But if you look at the way the bill is structured, the bulk of that stimulus comes in 2026.
Yes.
And there is some in 2025, which is why there's a rush to get it done. So I think this is all, again, part and parcel of the administration trying to ramp things up going into the midterm elections in 2026.
So if we have the bulk of the stimulus happening in the short term, does that mean sort of the ruptures we get from the concern about deficit, the irresponsibility of it, that the timing is that you first get the stimulus and then those concerns come later?
Unfortunately, the question is, will those concerns ever come? Because we've been talking about budget deficits since Ronald Reagan went from 50 plus to 50 minus billion surpluses or deficits to 450 billion. We've been calling the end of the bond market. We also thought we'd never get back to a balanced budget, and we did. It took us a long time, but we did get back to it. And there was a time we were worried about the scarcity of Treasury debt. So the reality is the markets are big. Nobody else is borrowing but the federal government. Households are deleveraging. Corporates are deleveraging. The net demands on capital markets are not great. And that's the reason why long-term real yields are not being pushed higher.
Just one other thing on that. If we are going to be getting a bulk of stimulus in 2026, it's also when we'll have a new Fed chair. What happens if we get that stimulus at the same time we have a leading voice at the Fed who is pushing for more and sharper rate cuts?
The thing that I think people are missing over and over again is when you look at the dot plot, because we all love the dot plot, right? The chairman is one dot on that dot plot, and there is no bold dot to indicate the chairman's vote. The chairman is one vote. The chairman doesn't determine what the committee does. And this is where I think there's a misperception about what happens. Yes, the chair may be able to influence the debate, but at the end of the day, the committee takes the vote, and it's the committee's vote that counts.
Is But it is a precedent. I mean, it is convention, let's say, to follow the Fed chief, to have him be the leading voice. Are we entering a period then where convention is thrown aside? And doesn't that complicate the Fed's communication? Because when the Fed chief speaks, it's something you listen to because of that power that they have.
The Fed chair speaks for the committee. And that's part of the process of why the Fed's vote, the chairman's voice gets to be heard more, because they speak for the committee. The committee, however, is what he's speaking for, and not for him or her own personal opinion. And we have seen historically in my day, not most people's day, where a Fed chair went into a vote and was outvoted, and he subsequently went to the White House to resign. And this was Paul Volcker. The only chairman in modern history whose vote counted more was Alan Greenspan. And, we saw where that got us in terms of the financial crisis. Chairmen are one vote. That's it. They can't determine what's going to happen. The committee makes the decision. There's decorum. There's process. They have certain things they have to do. They have a dual mandate. It's all legislated by law. The ability of the chairman to influence the vote is one vote.
Steve, before we go, I just want to leave it on one other question, because the Wall Street Journal had this really interesting story today, basically saying CEOs are saying the quiet part out loud. They're talking now about how AI is going to be resulting in job cuts. Everyone from Ford to Microsoft. Andy Jassy had a really strongly worded email to his employees, basically saying some of your jobs are going to be replaced by AI. You should probably get on top of this thing. Have we started this cycle yet of AI displacement? Has it begun, or is this a concern further out in the future?
Again, when the technology revolution began, when the internet explosion took place, when computers showed up on people's desks, large sections of publication systems went obsolete. And over the years, we went from having secretaries and typing pools and everything. All those jobs are gone. Okay? At the end of the day, employment's still higher. We can focus on the negative. We don't see the positive. The reality is there are a lot of other jobs that will be created as a result of AI, freeing up resources from other areas, because money that's not being spent on those people is going to be spent on new investment. And that new investment is then what drives the economy. And this is where it's easy to identify negative. It's harder to see the positives. And this is why it's easier to tell a bear story than it is to tell a bull story.
Yeah, I mean, these hyperscalers have been spending so much on it. So, I mean, at least that is certainly playing out now. Steve, thank you so much for joining.
Cheers.
Really, really great to have you on, especially on a Thursday that feels pretty much like a Friday, which I think we're all happy about. Mizuho's Stephen Ricchiuto there. Coming up, we were just talking about it. We're going to get back to it. House lawmakers debating President Trump's tax bill right at this moment, ahead of the final votes. We're going to have more on that coming up next.
That diagnosis changed my life. And while I am grateful to be here, I can know
It's been a good day. We're in a good place right now. This is the legislative process. This is exactly how I think the framers intended for it to work. We feel very good about where we are, and we're moving forward. So we're going to deliver the big, beautiful bill, the President's America First agenda, and we're going to do right by the American people. This is going to be a great thing for the country. Look forward to moving it forward.
Speaker Mike Johnson confident that a vote will be finalized this morning in the early hours. You're also looking at live pictures of Minority Leader Hakeem Jeffries. He's expected to speak on the floor for about an hour as lawmakers gear up for a final vote on President Trump's tax bill. Bloomberg's Tyler Kendall joins us now from Washington. Tyler, the procedural hurdle was cleared. What now?
Yeah. Hey, Danny. Good morning. So it appears it took this overnight session, but Republicans are on track for final passage of President Trump's one big, beautiful bill. To sort of get our bearings here, what's happening right now is House Democratic leader Hakeem Jeffries is speaking. He's afforded something known as the magic minute, which means he can essentially go on for as long as he wants. He started speaking at 4:54 a.m. Eastern, and our reporting indicates we're expecting him to go about an hour or so. And once he finishes, then that's when the vote on final passage will begin. We are not expecting the final vote to actually take that long because it does appear that they've reached some sort of deal, some sort of agreement with those holdout Republicans to get them on board. So we're expecting it to be a pretty snappy vote at the end of the day in order to get it over the finish line. And that's really one of the big questions remaining here. What did those holdout Republicans, particularly members of the House Freedom Caucus, get in exchange for their votes? Because I have to say, I was on Capitol Hill yesterday. I spoke with Congressman Chip Roy, a Republican from Texas, who was one of those holdouts and threatening to bring the Senate back into Washington in order to negotiate this. But for context, the House is voting on the Senate's bill with no changes. This bill is not ping-ponging between the chambers because that would have taken way too much time and they would have failed to meet President Trump's July 4th deadline. So we're waiting for any sort of indications on if the White House offered, for example, executive orders or promises of more legislation down the line in order to get their votes on board. That's going to be really critical here. Or did, Danny, President Trump's pressure enough? Was that enough to get the Republicans over the finish line? Just lastly, I will say the magic number that we are looking for going forward is 217. That is what they need in order to pass this package.
What sort of pressure have we seen from the president, Tyler? Because it does seem that he had been putting statements out on Truth Social all throughout the night as these votes were taking place.
So we know that he was in constant contact, was the framing that an administration official told us here at Bloomberg News. When it comes to the sort of calls that he was making, he also had invited some of the members to the White House yesterday. Though I have to say, after those Republicans did return to Capitol Hill, it didn't appear to be enough. So they started to dispatch administration officials to Capitol Hill overnight. And one of the themes that we keep hearing about is that administration officials spoke about the fiscal trajectory of the country. We know that they like to talk about the idea of stabilizing the debt to GDP ratio when fiscal Hoxha raised concerns about how this will add to our mounting national debt. They also like to talk about tariffs as a revenue raiser, for example. So we have a feeling that a lot of those conversations were probably happening overnight. So that's sort of the pressure that was applied yesterday. But more broadly, if we look at the holistic picture, President Trump has been threatening to primary some of these members if they don't get on board with his bill. And I will point you to one member in particular, Thomas Massie, a Republican from Kentucky, voted against this bill back in May, but he flipped his vote and he voted in favor of the rule earlier this morning. And that is significant because it does appear that he's trying to make amends with the Trump administration, since we know that he would like to see the pressure let up after President Trump did launch a super PAC to fundraise against him in his primary, even if he did get a boost from Elon Musk.
Tyler, after this bill does pass, we've heard from the likes of Kevin Hassett saying that after it passes, trade deals can come through. We already got one from Vietnam late yesterday. Is that the order of things? Should we expect more announcements from this White House once the bill is finished?
Well, that's definitely what the White House would like to see happen. We know that they are trying to show forward progress. And it was interesting to hear the surprise announcement yesterday from President Trump announcing what the tariff levels would be when it does come to Vietnam. We are watching very closely a few other economies in Asia that this administration has indicated could be top of the line and priority for them in order to advance that agenda. It's really important to them because they are looking for a confluence of different economic factors to happen over the summer. First was the taxes, then they want to see the tariffs, and they really want to tout the revenue that they are getting from the tariffs as well.
Tyler, thank you so much for your coverage. Looking forward to it all morning as we track the votes. Tyler Kendall in Washington. Meanwhile, the Trump administration has also lifted export license requirements for chip design software sales in China as part of the trade deal to ease some restrictions on critical technology. Some of the affected software providers include Synopsys and Cadence Design Systems. They're both jumping in the pre-market trade. Joining us now is Bloomberg's Peter Elstrom. Peter, why the let-up in this restriction?
Yeah, Danny, it was just in May that we heard from these companies that they had been hit with these new restrictions on what they could do, what they could sell to their Chinese customers. It seemed like the Trump administration was pretty determined to convince these companies. They supply EDA equipment, electronic design automation tools. These are software tools that companies use to actually design semiconductors. The Trump administration wanted them to stop selling those tools into Chinese customers as part of this broader strategy of trying to hold back China's advances in technologies, critical technologies, particularly semiconductors. Now what we're hearing is that's back, they're pulling back. This is part of the broader trade talks where the U.S. and China are trying to reach some sort of compromise when China pulled back on shipping rare earths and minerals into the United States, this EDA restriction was put into place in reaction to that. So now we're seeing a let up as the two countries kind of back away from that extreme position that they had in the past with these trade talks, and they're moving towards some sort of compromise.
There's that element of it, Peter, but then there's also the likes of Jensen Huang, who's been very vocal in saying that what is happening with these restrictions is limiting American technology's ability to grow, and instead you just get more homegrown Chinese technology that can supplant it. Does this suggest at all a Trump administration that's more amenable to that argument at all, Peter?
Well, it's interesting. You definitely hear that argument much more, especially from Jensen Huang, who, of course, has a lot of money on the line. NVIDIA would love to be able to sell all of their AI chips into the Chinese markets and many other markets, too. What we did not hear, though, is that the Trump administration is backing off NVIDIA chips in particular and restrictions on them being sold into China. Those are much more sensitive. Those can be used to train the kind of AI models that you would see from the likes of DeepSeek and Alibaba. They're pushing quite hard to develop those technologies. So allowing EDA tools to be sold into Chinese customers is one thing, but allowing NVIDIA's most advanced chips to be sold into Chinese customers is not on the table at this point. That's much more serious and does not look like they're going there. But you raise a good point. There is this argument that if NVIDIA is able to sell into the Chinese customers, then those Chinese customers are not going to turn to domestic alternatives. Huawei so far has been the most advanced at developing alternatives to NVIDIA chips. If Huawei is able to get pretty good volumes and pretty good revenue from this, they'd have more resources to be able to pump into that effort, the research effort that they're making right now. So that's the argument. We've heard a bit about it. It doesn't look like that side is winning at this point, but they're not done certainly making that argument.
Peter, really appreciate it. That is Bloomberg's Peter Elstrom. Now, coming up, we're going to set you up for your holiday-shortened week. We're going to have data coming ahead of July 4th. That's next. This is Bloomberg. Let's get you set up for your trading day on this Thursday. House lawmakers are set for a final vote on President Trump's tax and spending package this morning. Plus, we get a lot of data because markets are closed tomorrow. We're going to get the jobs report, jobless claims, all those at 8:30 a.m. Then PMIs at 9:45 and 10 a.m. Eastern. And just as a reminder, U.S. equity markets will be closing early, 1 p.m. ahead of the July 4th holiday. All right, a check on your bond market. Ahead of that jobs data, 106,000 is the estimate, 95,000 is the whisper number, but perhaps what's driving things more this morning is what's happening in the UK. You can see 10-year yields down by 8 basis points. That's after a lift of nearly 16 basis points yesterday. That was the biggest rupture in UK bond markets since the Liberation Day turmoil in April, all of that surrounding concerns about the fiscal deficit there and whether the chancellor would stay on. So it is a global bond market rally this morning. All right, that's it for your Bloomberg Brief. Surveillance takes things from here. This is Bloomberg.